When it comes to the consultation process and the draft, how are these plans meant to raise governance standards?
I think the first point to make is Australian companies are well governed. So there's not a fundamental governance issue. Internationally, Australian companies are well governed, they're well respected, they have the trust of capital markets. But these principles had become a bit outdated. In truth, they'd become too complicated. In parts, they were too prescriptive. So our goal here is to simplify them, modernise them, and there are a number of areas where corporate governance standards have improved or been lifted over recent times, and we seek to address that. They'd be in the areas of diversity, in remuneration, and in culture. So they're very much the focus areas of the revisions.
And what particular area would you like to see the most work done in?
Well, there's no particular, the one that I want to focus on is culture. Because companies perform well if they have a culture of doing the right thing, a culture of high standards, a culture of excellence. And the previous set of standards didn't really focus very much on culture. They'd said the board need to oversee some policies, but what's really important is that a board oversees a strong, resilient culture of doing the right thing. And we've modified the recommendations in this area to make it clear that the board has a responsibility to instill a culture of doing the right thing. So that's really important, because if you look across the corporate scandals over the past 4 or 5 years, they've often come down to culture.
What does that mean in practice in terms of what organisations can and should be doing on a day-to-day basis to make sure that that culture is honest and it's pushing the organisation in a right direction so those scandals don't happen?
I think it really starts from the top, so that's the top management, but also the board, sending a clear message to the organisation that they expect people to act ethically, responsibly and legally, and that if you do not do that, there'll be consequences. So that really needs to kind of be part of the DNA of the organisation. Reminding people what they're there to do. They're there to do the right thing, to build long-term shareholder value, and to treat people with respect and ethically. So if you can do that, that sets the company up for success. But if you don't do that, if people don't act responsibly or ethically, if they don't treat people well, then it might work for a while, but you get found out and the company will suffer and the shareholders will suffer. So acting ethically, responsibly, and having that part of the DNA of the organisation, I think, is really successful, the foundation for success of any company. And really, as a director of the company, you have a responsibility to make sure that management do this, because ultimately it's management's responsibility, isn't it? But the board has to monitor the management and help and encourage the management to establish a strong culture of acting ethically and responsibly. It's foundational.
What scandals in those past 4 or 5 years, as you've mentioned, have caused you the most alarm and the most concern?
Well, I don't want to kind of highlight any particular company, but there have been failures where the company drifted from its core purpose, and for whatever reasons the board wasn't able to help get management back onto the right path. So I don't want to kind of single out any particular companies, but I think people know the kind of the examples. But the fundamental point is that a strongly performing company starts with a strong culture, and that's management's responsibility, but the board has a responsibility to monitor the management and to help and assist the management, and to make sure the management know that if the culture isn't aligned with the firm's values, then there are consequences for the management.
And you speak of some of the principles being outdated. What does that mean? Which parts really are a bit old-fashioned and need to be refreshed?
Well, there was a lot of overlap with regulatory requirements. So there was a principle that you had to have a whistleblowing policy. Well, that's set out in law. The same with AML. There were principles about disclosure of climate and sustainability risks. Well, that's all set out in the law. So we went through the principles with a fine-tooth comb, and where an issue was already covered in the law, we decided to take it out, because it was just adding to confusion and what wasn't adding any value. So that was a simplification. Another simplification was that we have sought to clarify the guidance. The principles have 8 principles, which is fine. Then they have 40+ recommendations, and then there's a set of notes. Often the guidance notes were, in effect, adding more recommendations. So it was a bit confusing, and people were saying to us, well, look, we're not really sure what we're supposed to do here. So we've made it very clear, the 8 high-level principles, the recommendations, and then guidance, which is exactly that. It's not providing more requirements that you have to meet. So that hopefully makes it easier and simpler for people to use and to report against.
What's the advisory group's position when it comes to those diversity targets for boards? What's your thinking around those issues?
We've spent a lot of time talking about diversity because culture is important, but diversity is important as well. All the evidence is that more diverse boards give better value for the company. So we want to have diverse boards. In my view, too much of the diversity discussion is focused on the issue of gender. It's gender is incredibly important, but it's only one aspect of diversity. You don't want a board made up of 10 men or 10 women or 10 people from the same private schools or 10 people from the same background or 10 engineers. So the best boards are going to be boards that are constituted of people who come from different backgrounds because they can bring different perspectives to issue and monitor management more effectively. So the recommendations now focus a lot on the importance of having diversity of experience, perspective, skills. So that's new, and what we expect boards to do is to assess how they're treating diversity and succession planning, and talk to their shareholders, to the investors, about how they're ensuring that there's a diverse set of members on the board. On gender, we've kept the 30% expectation that 30% of directors are women. We kept it because it's really worked well. Now, before this was brought in, maybe only a quarter of Australian companies had more than 30% of their directors as women. Today, in the ASX 300, around 75%, so 3/4 of companies have more than 30% of directors as women. So that's really worked. It's been successful, and I think Australian companies are better governed as a result of that. The issue we discussed quite a lot, and I know a lot of your members will have an interest in this, is whether we should go further, go up to 40%, because there are some people who advocate that. We haven't ruled that out as a future change, but at the moment we wanted to broaden the concept of diversity to these other characteristics I talked about. But we also want the 25% of companies that don't have 30% women as directors to get there. And I think if we can get them there over time, which I hope we do, then there can be a conversation about lifting it to 40. But it's been successful. We want everyone to get there, and then if everyone gets there, then we can lift the floor. And of course, if an individual company thinks that 40% is the right target for it, they can do that. These are not mandatory requirements. This is kind of a minimum. And if you're outside the ASX 300, we expect you to set a target and to lift that target over time.
And when you talk about improving culture, isn't it true that if you have greater female representation, more towards the 40%, that would enhance the culture that you're keen to enhance?
Yeah, I think kind of having the lift from up to 30% has been really important. But having people from different perspectives is culture as well. It's not just gender that kind of brings perspective. It's people's education, it's their life experience, it's their industry skills, it's their whole mindset. So each of these things are important. The floor for women is 30%. Hopefully that will lift up over time, but let's get everyone there first and do some work in the interim on these other aspects of diversity, because we don't want all people from the same private schools in Sydney and Melbourne sitting on boards. You want people from different backgrounds. You don't want them all to go to the same university. So you'll get, I think, a stronger culture if you've got people from different perspectives, and hopefully we'll do that.
What about work within the draft to simplify reporting, cutting red tape, making life easier for businesses? Is that part of it?
That's really important, because what we want is a vibrant public capital market. We want companies to be able to list on the Australian share market. It provides a vehicle for people to put their savings and It gives people liquidity and allows companies to raise capital. So that, and it brings transparency to investment. So having a strong public capital market is really, really important. So we don't want to have unnecessary roadblocks in the way. You know, if you make things too complicated, then companies will say, well, do I really want to list on the public capital market? Well, I just stay private. In some cases, private's the right answer, but it shouldn't be the right answer because we've made it too difficult, too burdensome to list in the public capital markets. And I fear we were kind of drifting into that. It become a bit complicated. So this greater clarity between the recommendations and the guidance, I think, will simplify reporting. I know the ASX is going to retire its guidance note 9, which was kind of adding to the complication, so that will simplify things. And one of the other issues that we're very interested in people's perspectives on is this Appendix 4G, which is a extra form that companies have to fill out about, it's almost tick a box. Did you comply with this? Did you comply with that? If you didn't comply, where's your explanation? So it's quite a burdensome thing for companies to do. Other countries don't require it. So we're interested in people's perspective whether the regulatory burden could be lifted without any deterioration in the quality of information by not continuing with that appendix. But some people like it, other people don't. So we're trying to simplify the requirements and simplify the guidance and maybe simplify the reporting as well. It should make life easier for both company directors and company secretaries. And if their life's easier and we don't have any reduction in the quality of the standards, then the public capital markets are more attractive for people to go to, and having companies listed in the public capital markets are good for the countries I mentioned before.
The next question is in two parts. Is it true that the number of listed companies is going down? And if it is one reason is because it's not very attractive and it's too burdensome for organisations?
I think in the broad scheme of things, it's pretty steady. There's around 1,900 listed entities on the ASX. So, some very big companies and some not so big ones. I don't think these principles are the reason that companies don't list, but they could become, if we introduced requirements into these principles that were very onerous or a lot of reporting, then people say, well, it's just all too difficult, isn't it? So we want these principles to deliver high standards, strong principles, but not too complicated. We want them to be guided by common sense. This is another discussion we've had at our committee. What's the common sense approach here? What's the approach that people say, yeah, well, that makes sense. We should be doing that anyhow. So most company directors are people of goodwill. They want to do the right thing. They want to act professionally. They want to kind of abide by good process. So what we want, hopefully, most directors to do is to read these principles and say, this makes sense. Of course I should be doing this. And I think most of the principles are like that. And if that's how they're feeling, then that will help them run their companies more effectively, and these principles actually help build trust in the company, and if there's trust in the company, then it's easy to be in the public space. But you could go the other way and you make these things just too difficult, and then companies decide to go private. And it might be the right answer for some, but for many cases it's not. Because remember, if companies are private, then mum and dad investors don't get to invest in them. The company doesn't have liquidity. There's no transparency about the value of the company, and it's harder for the company to go to the capital markets because it doesn't have a kind of a liquid shareholder base that it can draw on. So being in the public capital markets has a lot of advantages for companies, investors, and I think the country. And I'm hoping these principles help make being in the public capital markets more attractive.
And did the independent advisory group that you chaired, Dr. Lowe, consider different regulations for smaller companies because perhaps they might need to be treated a bit differently?
I'm glad you asked that because it allows me to kind of focus on an important aspect of these principles, and that's the if not, why not approach. So we've got eight broad principles and 40 plus recommendations. But the whole rationale is we want to give companies flexibility. The recommendations are one way of meeting the high-level principle. But there are a lot of other ways of meeting them as well. And we're saying to companies, if you want to meet the high-level principle in different ways, very good. Just explain to your shareholders what alternative arrangements you've put in place, explain your logic and how the different arrangement that you put in place actually satisfies the principles. So one of them that comes up periodically is the principles say that companies should have a separate nominations committee to look at kind of renewal, etc. But in smaller companies with small boards, they might say, well, the board itself can do that. It doesn't need a separate nominations committee, and that's perfectly fine and actually makes sense, and you'd want them to do it. And what we want companies to do in that case is to say, no, we haven't got a separate nominations committee because the board considers nominations in its entirety, and it does this for this reasons, and these are our processes. So that's good. And another one that's come up quite a lot is director remuneration. There's a recommendation that says that in most cases the directors should be paid by a fixed fee. So $100,000 or whatever the number is, and it should be fixed, and you can pay it in cash or you can pay it in shares. In most cases, paying a director, I think, fixed fee is the right thing to do. But if you're a small startup, tech or mining company, you mightn't have the cash, and you might want to pay the director in form of an option or some other financial instrument. And we're saying that's okay. But if you do that, you need to explain your logic, you need to value those options appropriately, and you need to explain the transition path to kind of paying in terms of fixed fees. So you've got to disclose what you're doing, why you're doing it, and your logic. And that's a better way of dealing with the dispersion in experience across the 1,900 companies, because otherwise you'd be trying to write one set of rules for this company and another, there'd be a cut-off, there'd be a hard line. I mean, it just becomes a minefield of kind of excess regulation. So the better approach is to set some principles that most companies would abide by and give them flexibility to do something else. And if they use something else, then they expect to explain it and their rationale, their logic and what those arrangements are. And then let the owners, the shareholders, say whether they're happy with that. And if they're not, then they vote the board out. That's a better model than us sitting there saying, well, if you're in the ASX 300, you do it this way. If you're 300 to 1,000, you do it this way. If you're 1,000 to 2,000, you do it. You could imagine how complicated that would become.
What about the rise of AI in your thinking and your broader thinking about governance in this space? To what extent has the rise and the opportunities and the pitfalls of AI influenced the way that the board not only thinks about the principles, but in the way that you think more broadly about protecting the integrity of the system?
We've had quite a long discussion about that, and there's some commentary in the explanatory material about directors using AI. Our high-level thinking was that it's certainly fine, appropriate, and probably the right thing to do for directors to use AI to go through the board pack to kind of work out what the main messages are. That's a really good tool, but we want to highlight the fact that it's not a replacement for directors exercising sound judgment based on their experience. That's the fundamental requirement of a director, to use their experience and judgment to come up with strategies or approaches. They need to do that, and AI is not a replacement for that. So it's a tool, but it's not a replacement. So I think another area that we've focused on is and this has come up in some court judgments as well, is the length of board packs. Some board packs in some companies, hundreds, some even 1,000. I mean, it's ridiculous. And so directors kind of use AI to help them with that. Probably the better approach is for kind of board packs to be narrowed down to something that's kind of more digestible. Because in the end, we want the directors to use their judgment and experience, and they have to do that. They've got a legal responsibility to do it, and they can't outsource judgment and experience.
When you were Governor of the Reserve Bank of Australia, you were the steward through the pandemic, through some of the most uncertain periods of modern history. When you think of AI, the blessing and the curse, the opportunity and the fear around AI, how do you think that the modern board should be grappling with not only the issues that you've raised regarding board papers, but more broadly in terms of how AI should be used ethically, responsibly across an organisation?
Yeah, well, the starting point for all these discussions is what's the company's values, what's its objective, and what's its strategy. And then AI can help with the strategy, it can help do tasks more effectively. But from my perspective, the starting place is what do we as a company stand for, and what are we trying to do, and what are our values? And then I think about how this tool aligns with that. And for every company, it's going to be different. For some companies, it's just going to be these tools that kind of help with tasks and just make tasks more efficient. Adopt it. In other companies, it's going to fundamentally reshape the business, and then you've got these strategic issues to consider. So for every company, it's going to be different. And for some companies, it's going to open up deep philosophical and ethical issues. And the company board is going to have to work through those. And it's going to have to do it using, its starting point is values and its ethics. So it's not easy. So it ranges from kind of modernisation of simple tasks, making a nice PowerPoint presentation, to fundamentally raising kind of issues about the roles of humans in organisations. So no one knows where all this is going to lead, but the board has a responsibility to ask management and to ensure that the company is acting consistently with its ethics and values.
And you have spoken about Australia's economy lagging behind others in terms of wages and inflation. And when it comes to these governance principles that you have drafted and are now being consulted broadly, how can the principles reignite the economy? What part can those principles play in terms of lifting living standards that are stagnated in this country?
I think it's pretty, realistically, not very much. The fundamental problem that we now face is per capita incomes have stagnated really for 7 years. Per capita incomes in Australia used to rise at 1.5% a year. We had strong productivity growth, we had the China boom, we had favourable demographics. The China boom's over, demographics are turned against us, and productivity growth is zero. So for 7 years, really, we've had no lift in per capita incomes, and that's coming as a huge shock to everybody, to people, and it's the source of the cost of living crisis and the unhappiness that people feel. There are a lot of reasons why this has happened. One that I've focused on recently is weak levels of business investment. The population's been growing quickly, but business has not been investing very much, and so the country's capital stock hasn't been rising very quickly. And the clearest example of this is the housing market, where the population grew quickly. We didn't invest enough in housing, the number of houses didn't keep pace with population, prices rise, people get unhappy. But that's just but one of many, many examples across the country where weak investment is causing kind of problems for the country. The solution is to make Australia a great place for business to invest, expand, innovate and hire people. And that requires reform right across the whole range of things. I think where these principles fit into that is if we can make going to the public capital markets attractive, then firms find it easier to raise money, and if they can raise money, then business investment can be higher and the allocation of capital across the economy can be more efficient. So the public capital markets have an important role in raising the possibility of getting capital and allocating that capital across. So and if we can do that, then we can have stronger investment. But, I'm realistic. That's just but one very small piece in a much bigger challenge the country faces of making it, Australia, a great place to invest, innovate, expand and hire people. And we should be, because we've got fantastic fundamentals. Great resource base, trade links with Asia, a stable democracy, talented people, growing population, good education system, strong rule of law. So we've got all the fundamentals, but I feel like we've got getting in our own way with too much regulation and policy reforms that are making it too hard for people to invest, innovate, expand and hire people. And the results are now in the stagnation of our living standards, and unless we change, our kids won't have a higher living standard than us. Probably it'll be lower. We've got the fundamentals to do well, but we're not doing it. These principles aren't going to change that. They help at the margin, but everyone's got to do the bit. And this is the bit that the ASX can do.
And one final question. Here at the Governance Institute of Australia, we believe that governance is a shared national strength. And when you look at your career, not only at the Reserve Bank, but before and after, how important is sound governance in terms of lifting the economy, improving the business investment that you speak of? How important is it for us to get these things right so that the country can prosper in a way that it should finally?
Yeah, no, well, it's incredibly important. I used to travel a lot in my previous role, and I detected very strongly that internationally Australia was regarded as a very well-governed country. Now, our political system has its problems. Basically, it works most of the time. Australian corporations are well-governed. The problems occur periodically, but the problems are surfaced and fixed. We have good public policy institutions, the Reserve Bank and the Productivity Commission, and there's the courts and the laws. The legal system works well. So we're regarded as one of the best governed countries in the world. And it's important because if you're regarded as well governed, then people trust you, risk premiums are less, they're prepared, overseas investors want to invest in Australia, partly because of the fabulous fundamentals I talked about, but partly because they can trust us. So trust is the foundation of finance. I think trust is often the foundation of business, and good governance and processes and culture help build that trust. So if we can Australia can continue to be a trusted, well-governed country, which is transparent, problems arise, they will always arise, but they're fixed up through a transparent process, then I think we can continue to attract capital and allocate that capital as effectively as we possibly can. So good governance is fundamental to the country's success. We've just got to get kind of other elements lined up, but the governance piece I think is there, and we've got to keep working on it. And we have to keep looking at it. As I said, these principles were last revised in 2019, and quite a lot has changed since then. So we need to keep working on this, and if we keep working on it, we'll continue to deserve the reputation that we have for being a well-governed country.
Dr. Phillip Lowe, thank you so much for coming in.
Thank you very much for your time.